Good morning, everybody. Welcome to the Flow Show. It's Tuesday, the 28th of Feb, last day of the month, and it looks like it might be a spicy one as well. Morning, Stel. Morning, Kay.
Hello, hello. How is everybody doing?
All good. You finished sailing around the Greek islands?
Yeah, just for a few more days. Now, next one is in April, so we have some time.
Hard life. You lot, Luke. How are you, Kay? You feeling a bit better, mate?
Yeah. It's going better. Still not perfect nights, but it's going better. Looks really like weekend stuff to me. I'm too much time on my hands to catch colds and stuff.
Yeah. You have to get your old bike out again. Get riding around.
It's about time, mate.
Right. Well, let's get into things. A few bits and pieces going on. Not too much on the headline front, but still we've got plenty of market moves to talk about. Going to start with some data out of Japan yesterday. A few numbers there. We got retail sales looking a bit better on the month, but industrial production looking a bit soggy, down 4.6%, worse than expected month on month, to minus 2.6 expected. Although 1 month ahead expectations looking a bit better, a bit more positive on for the future. But again, we're seeing this divergence a bit between what's happening in the manufacturing production side and what's happening in the services side. And that's been evident as well in Japan. Bank of Japan's Wakatabe says 2% inflation target is yet to be reached, even while inflation is running around 4.3%. So they haven't hit their target yet for 2% inflation. Work that one out. A couple more of the deputy governor nominees were speaking yesterday as well. Uchida said need to firmly support the economy with easing. Japan is no longer in a situation that can be described as deflation after years of monetary stimulus, and that widening the yield target band itself would weaken the effects of easing. So not surprisingly, given what we've heard so far from Ueda, but surprisingly overall, is they all seem to be taking the same lines as the prior lot, in keeping a very easy sentiment. Again, this, as Kay's mentioned plenty of times, really seems like they might be missing an opportunity here to finally get the market ready for tightening. Even if it doesn't necessarily happen that fast, the window of opportunity continues to close. One of the deputy governors, Himino, said that current BOJ easing is appropriate. We've had this conversation already, Kay, but it's another repeat, isn't it, from these lot? No,
I mean,
rhetoric at all.
Yeah, I don't understand why Ueda and his incoming deputies are not a little more, I wouldn't even call it hawkish, but less dovish. But they just seem to be happy with what Kuroda has been doing, and I'm actually surprised because I was of the impression that Kishida wanted to break a little bit with the tradition, but
yeah, exactly.
The fact that they keep on mentioning the government finances as well, perhaps not overnight, but is clearly a sign that they are not going to break any pots, or at least that's the impression that we get now. Again, I'm not sure whether we are not going to see a last surprise by Kuroda, because he's had the habit to surprise markets over the years. On the 10th of March, that he would go out with a bang and do something just to prepare the field for the other guys. But for the time being, of what we hear and what they say, there's no big shock coming. There's no big reformer. The big reformer, the way that could have been, is not showing. Maybe cultural. Eric says maybe cultural. Don't want to step on Kuroda's toes before he leaves. Yeah, but that's not. Yeah, it is Japanese. I agree, but there should have been more hints at doing something, because you can just give the markets what they want, and give because the UREDA has been grilled by some of the politicians saying like, why are we in this tight straitjacket for years, even decades, and UREDA had the chance there to say something, and not even shocking, not even stepping on Kuroda's toes, but just saying like, yeah, we are in a we are going to use this window of opportunity to normalize monetary policy a little bit, and then he could add, it's going to be a very, very slow process, but we haven't even got that. So
yeah, he's not even played both sides of the fence, has he? Really?
Yeah, that's the thing. The only little thing he said was like they will be looking at economic data, but that's the same thing as any other central bank right now, which is they're all data dependent, right? So yeah,
there's not even a but if. You know, you could say, okay, we don't think inflation is going to stay high. It's at 4.3% or whatever. We don't think this is going to stay up for long. But if it does, we've got the tools to respond, and we'll respond. You know, that's what the Fed did all through the period. They're not even going into that part of it.
No.
And it's just,
unless we get a shock, if wages really go higher, and then we can be in for a shock. Who knows? But maybe UEDA is going to surprise us after all. But for the time being, and that for the next month, because before he takes office, it's not giving the markets any food for getting bullish yen or hawkish Bank of Japan, right? So
yeah. Do you think they're scared of saying something right now before they're in the hot seat, because they don't want to upset markets that much? They're scared of upsetting markets too much by even hinting about tightening.
Yeah, but I mean, if you look at the yen levels, and let's face it, in Japan, central bank independence is just a term, right? It's not really there, because especially from Abenomics onwards, the government and the Bank of Japan and the MOF have been just riding one train altogether. Yeah, I mean, we haven't got anything saying that, and if you look at the yen level, they have that is the extra opportunity for them to change something, because if imagine that in the global terms, okay, in global terms, they start to change monetary policy, and dollar yen goes back to 120, 125 or so. There's still nothing. I mean, nothing dramatic. We've been trading dollar yen inside a, call it 100, 115 range for years, and if we are at yen levels, and whether it is via the dollar yen or via all the yen process, where it's the opportunity, that's an extra opportunity for them to do something, because there is no danger for the yen to go too strong right now.
Yeah, exactly. They're still on the right side of it.
Yeah,
you know, where can it go from here? You know, if they do start tightening, it's a really slow process, as you say. You know, maybe you might get down to 120, but you're not going to be going all the way down to 175 and that sort of level, are you?
No, there is absolutely no danger for that right now, especially that if as everyone expects now, and we are not the only ones saying that now, well, I mean, some of them were speculating that they may go a bit harder, but they are not going to do anything silly, or because they don't want to put the government finances in danger either. So the risk for the yen, dollar yen, to go back to 100 is slim right now, right? But if in turn they do nothing, then I think there's a real risk that this market is going to take the Japanese yen on, and 150 is not going to be your final station, you know. And then we are talking about different levels, and then they are going to have to go to work to do something, and they are going to be forced to change stuff, and then it's going to be worse, in my opinion. So yeah, and as we have been saying, the window of opportunity is there now, and they better use it. They better use it. But we haven't heard as much so far.
No, well, as you say, if the I don't know how long they're going to watch inflation staying up around there. They've already touted that next month's inflation numbers are going to pull back. So perhaps they know something we don't. But
And
still, you know.
And an extra issue is that they are their current account for the time being is either hovering around zero or negative. So if they don't do much and the global economy doesn't really pick up for Japan to export more and more and more, they're just adding to problems for the Japanese yen possibly into the future. And there's a lot going against the yen right now. So I mean, changing the monetary policy would be a first step to in fact stabilize or put the yen on a better footing. Because of course, I mean, they always think about they've been in decades of weak yen is good for the exports and whatever. But for the time being, they are importing still a lot of energy and stuff because their nuclear plants are all in the plans to restart, but it takes months and months before the security details are all set and to start up again. So for the time being, they're still importing more than they export. So I don't think the yen level is helping them right now. So it would be everything now would point to them normalizing something, and unfortunately, it's not what we get from the first Ueda speeches or interviews or interventions.
Yeah, exactly. Well, it's a situation we need to watch, and we have still got those wage negotiations that we've heard a lot about, all coming into the end of quarter stuff. So still got some time to wait for that, just to hear what companies are going to be doing, you know, bigger. Also, the big whales, what are they going to be doing with their investment strategies going into the new financial year? So lots to come, and we shall see where we are come then. Looking at some of the other data coming into today. Let's have a look. Got some data out of
Canadian
Australia.
GDP. No,
What, sorry?
Canadian GDP is coming later today. Sorry.
Yeah. Aussie retail sales was out, and another January jump, and we've seen it around the globe. This January jump in retail sales, November and December was poor, and all these January numbers keep coming in on a decent beat. 1.9% versus 1.5 expected, down 3.9% in December. Not that you know it in the currency anyway. The Bank of Japan core measure of inflation came in unchanged at 3.1%. So maybe a bit in part of what they've been saying, what the bank said about expecting inflation to pull back from that 4.3% reading that we got the other week. Brexit, we finally got a deal. Look at that. A Brexit deal is finally on the table. Months and months and months, this Northern Irish stuff going on, and we got a deal. And when the deal was announced by the BBC, what happened to the pound? Well, cable dropped 5 pips. That was the essence of the move when the deal was announced.
Is it something that's final and done and signed, or is it something that's been
proposed?
Of course
not.
Of course, okay.
So
that's why. It's only been 5 years, you know. That's why the market doesn't care anymore.
Funny enough, I was having a conversation on Twitter with Michael Brown and Amanda Cooper from Reuters, and I said I'll make a market of 30 minutes before it gets picked apart, this deal, and I don't think I lasted 10. But
wait! They are tackling some really important issues, like they removed the ban on chilled sausages entering Northern Ireland from Britain. I mean, come on, this is very, very important stuff.
Hey,
sorry, I have to laugh.
Don't sausages. Sausages run the country.
Oh my God!
Can't have a fried breakfast without them. But yes, so the deal has been announced to much fanfare by Sunak and von der Leyen, and on paper it does look like it's going to be a winner because some of the heavy Brexiteers in Sunak's party, like Steve Baker, are behind it. A lot of other MPs are behind it too. The ERG, this little group within the Conservative Party that were heavy Brexiteers, they haven't fully got behind it, but they're not making big waves against it. The Northern Irish Party, the DUP, are reserving their comments at the moment. There was a lot of headlines that they were behind it as well, but they're going to be taking their time to go over it with a fine-tooth comb before giving their full verdict. But by and large, it is a bit of concessions on both sides to get to a deal. It does look more a case of it passing through and being done than not, as in the previous cases. But as mentioned, regarding the reaction in the pound, it's not been a huge mover for the quid because it's been on the table for several months now. And the last few weeks, the talk picked up that a deal was being done. So not a huge reaction in pound pairs initially on that news yesterday. But on a different slant, on the inflationary front, UK grocery price inflation hit a new record high at 17.1%, according to Kantar. So despite inflation maybe pulling back generally, what you're paying at the shops is still heading north. Grocery sales were up 8.8% in the 4 weeks to February 19th. That's from the same Kantar mob there. EURUSD said that the ECB is about to get to restrictive territory on rates. Markets are right to price in 50 basis points for March. The ECB will continue making rate decisions on a meeting-by-meeting basis. The ECB's role is not to say where the terminal rate should be. ECB's Lane was out saying a case for a 50 pip hike in March remains solid, and the ECB has started to win the inflation fight. Choice comments, considering that French inflation jumped 2 pips, as did Spain's inflation jump 2 pips. So higher reads for both of those. I think that's the second on the trot for those two countries, France and Spain, both seeing inflation back rising. So ECB's Lane starting to win the inflation fight, he says. Not if you're in Spain or France at the moment. Now, those moves there did set a little bit of a chain in motion this morning. We saw yields across Europe, mainly Spain and France. Where's my yields charts gone? Rallying quite strongly. Yields up a good chunk, nearly 10 basis points, well over 10 basis points really. That's got the euro well bid as well, particularly in the crosses. That also gave US 10s a little helpful nudge up to 3.96%. That's really this higher for longer narrative really kicking in. Now, that was happening in the US. Now it seems like it's going to happen in Europe as well, based on those inflation readings. Money markets are now fully pricing a 4% peak ECB rate for the first time. And on the rate probabilities, well, we're only pricing 58.5% chance of a 50 pip hike at the next meeting. And that's because we're also pricing a 75 pip hike at 41.5%. So the market definitely looking more hawkish for the ECB. What of those numbers, guys? That's 2 months on the trot now for France and Spain moving higher. Are we going to go back to the highs, or is this just a dead cat bounce?
That's a good question. It depends on energy, really. And we've talked about the Eurozone being a lot more dependent on energy prices because of all the imports, because the EU imports most of the energy compared to, let's say, the US. It is worrying that we're seeing a couple of prints higher than the previous ones. I'm of the opinion that inflation is going to recede eventually. Will we see a plateau here? Yeah, I think we could. But I still think inflation is going to be dropping on a year-on-year basis as we move forward. But we do need to see oil moving lower, and the cost of production, basically, of goods and services to be reducing. So I don't know. It's definitely giving the ECB reasons to be hawkish. more reasons to be hawkish. And but if you look at it, you know, there you have the chart, right? It looks like it's kind of plateauing. So yeah, maybe we get a couple of prints here and there, +1, +0.1, +0.2. You know, the big picture is that the big rate of increase is fallen dramatically. Now the rate of increase is kind of steady. And I mean, you know what I mean. I didn't express it properly, but you know, so for me, that's a big picture. I do think we're going to start dropping eventually. You know, I was talking about the end of this quarter for a while. Back in 2022, I was talking about the end of Q1 of 2023. Okay, maybe it takes a little bit longer, but I do think that we're going to be easing off going into the remaining of the year. The question is, how much do we ease off? You know, if we stick at you know, 5% and not go lower, then they have to keep going and going and going, right? That's the problem.
Yeah, I mean, it's a tale of two countries, really. You know, there's Spain that came off quite heavily, and they got to one of the highest, up in the 10% there, and they came off quite significantly. But we all knew and we all said it's not going to be a straight line. And they've seen a big drop in inflation, the rate of inflation down to, you know, just under 6%, and now it's creeping back up again. But you compare it to France, it's still at the peak. You know, there's no cause for peak inflation in France at the moment. It's still right up there. So yeah, you want to take it on a country to country basis and the Eurozone as a whole. But I never thought that inflation would be coming in a straight line back down to 2%, 3%, because it just doesn't move as quick as that on the way back down. Now you're getting all the price pressures coming in domestically. So yeah, we could see this turnaround again and see inflation coming down. But as I've always said, it's where inflation settles. It's where it does plateau out or stop. You know, Spain's coming down. Is it stopping around here? That's still 2.5%, 3%, 4% above the ECB's main target. The similar could happen in Germany. We see price pressures easing, but then they hold at a level that's not going down anymore. And that's what the ECB are going to take into account. What do you make of it, Kay?
I think I don't know about inflation. I tend to agree with Stelios that on a year-on-year basis, it's going to come off just because of mathematics, right? But I'm doubtful that we are going to go anywhere close to where they want it in over 2023 at least. Yeah, I think the higher for longer is still very much alive across the globe in the let's call it the major economies or so. Yeah, it's still going to be sticky, as we say. So yeah, money markets will have to continue to reprice, and I think it's also a little bit what we are seeing in on the back of the Northern Ireland deal. I think the market finally is trading it right now. They wanted the confirmation, and then if you look at the UK yields as well, they are pretty perky again this morning, and we are back to 385 on the UK 10s, and we haven't seen that since October really. So yeah, I think the market is still in the repricing phase, and then yeah, the rest is going to depend on data. Paradoxically, if CPI comes down, but economic data don't fall out of bed in the whole process, which they seem to show us right now, then you are going to have those yields remain even stickier, right?
Yeah.
The opposite would be true if CPI starts to fall, like Stel is expecting as well. And end of Q1, we're still not there. We still have a month to go, so we can still see the next batch of numbers, or from April or so, start to point lower. But if then we're seeing a peak in economic data as well and coming off, then you're going to have again the pendulum is going to swing again to the other side. So that's why I'm always saying on every time I've got the occasion to say so, we are ultra data dependent right now, and the money markets, we have seen big moves. If you look at you were showing those 10-year yield. If you look at those 10-year yields, starting 2023, stay on where you are there, right? The UK yield.
Yeah.
Starting 2023, we're trading around 3% in the UK 10s. We're up at 385. That's 85 basis points in 2 months' time. That's a lot. That's really a lot. And so the market
even less than that, I think,
accelerated.
just this month.
We are still in this, yeah, exactly, right? And we are still in this accelerated process of markets having to reprice stuff, which well gives us opportunities, but also provides for those pretty violent ranges once the yields are on the move in FX as well. So I still think that and we keep on repeating here, but I mean, if you want to have a clear overview on fundamentals and stuff, I mean, your first point of monitoring is yields and what the differentials are doing. So if inflation remains sticky, if economic data continue to hold up, I mean, there's very little that stands in the way for more repricing, and then I think we can see because you have expectations on the Fed or central banks. You're going to find that in the short end of the curve. But if economic data hold up, then the longer end of the curve has to correct more, and then you're going to see those 10s and anything in the belly from the 5, the 7, 10s, even 20, 30 years, they will have to reprice as well, and that's where I think your currencies will be on the move too.
Yeah, I mean, look at the difference between UK 10s and 2s. You know, UK 2s, you know, yields are under. Compare that to the US, it's you know, between there, it's nearly 100 basis points difference.
It's the other way around, and that's what I also said yesterday. Sorry, guys, I'm still a little bit short of breath. That's what I also said yesterday. There's a risk in the yield curve as well, building, I think, for the dollar. And I'm not trading it right now because economic data don't tell me this way, but the inversion of the curve in the US is starting to be massive, really massive. We are, if you look at the 2s and 10s, we are just shy. Well, I mean, it's 90 basis points or so this morning, but we are shy of 100 basis points. And sooner or later, either the market needs to reprice that and take the longer end of the curve a lot higher, which Stel was saying around 430s or so on the US 10s, or there's going to be something in the data that gives the market a reason for this big inversion, and then it's going to create, I think, an inflection point for the dollar at some stage. So that's something that I'm really starting to monitor closely. There's a few things that we need to monitor now, which is the nominal yields, the real yields, and the inversion of the curve. And as you rightly pointed out, the curve in UK, for instance, is especially between 2s and 10s, is still positive, and in a way that may help sterling, because that means that the market is not seeing too many problems in the future for the UK apparently, and perhaps this is now what we are seeing that's being reflected in the sterling. And I was saying yesterday, and I completely missed the opportunity that I was like looking for to buy cable at some point, and it's already 150 points higher, and euro sterling is lower, but there's some of those things that I'm keeping an eye on if we talk about fundamentals, which we do talk on this show about, or as long as everything goes well in the economy, the inversion is not a big problem. If numbers start to turn down, then this inversion could possibly create a big problem for the dollar at some stage.
Yeah, that's something we probably have to talk about at some stage. But just to try and explain what Kay's saying. So the yield curve is.
Oh, was I not clear enough?
No, you were, mate. I'm just talking about the what it means by inversion and the likes. So just for people who don't know, so when you're talking about the yield curve, it's dependent on whether it goes like that between the short end, like the 1 years, 2 years, and all the way down 5, 7s, 10s, 30, or whether it goes like that in the same thing. So that's what they mean by the curve. Just for anyone who doesn't know, understand what the curves mean, and they imply different things. Inversion can imply, usually is used as a measure of potential problems coming for the economy. But that's what we're seeing. The US is looking like that, and the UK is looking somewhat more like that. But let's get into the specifics of it. We can discuss at another point, but that's just to explain what the curve means for those that may not know. Let me get rid of them. How do I get rid of them? Oh, get rid of it in a minute. Right, just to finish up some of the data that we got as well. Let's get rid of that and that. Coming into yesterday in the US, we got durable goods, which undid quite a chunk of the move. It was a big jump last month, coming in at 5.1%. There were some big ticket items in there that showed up, aircraft and the like. So there's been a bit of a washout on the headline number. They're down 4.5%. However, the core number or the investment category, this one here, came in a decent 0.8%. And in fact, core goods came in positive at 0.7%. This one could be more reflective of what we saw in retail sales. We saw positive retail sales in January. And this core durable goods are things like white goods, TVs, fridges, freezers, that sort of thing, appliances, computer equipment, that sort of thing. So that's perhaps a bit reflective of what we saw in those retail sales numbers. But on the whole, a bit positive, even with that big negative headline. The underlying components still looking pretty good. Pending home sales came in a healthy 8.1% on the month. Not as bad on the year, falling 22.4% versus last year. Prior was minus 34.2%. So housing data's been a bit mixed. It's been more positive than negative right now. The NBA numbers have been, for February at least, have been going the other way. They were looking positive coming into the year. They've turned a bit south now, so the picture's a little bit mixed as to what's going to happen in the housing market. Obviously, rates expectations on things like 30-year mortgage rates have jumped again. I think they jumped from 6.39 to 6.62 last week. So as the market gets more hawkish, the Fed mortgage rates are going to be looking higher as well. Morgan Stanley have said that they do not see a rate cut from the Fed this year. They now see a rate cut coming in March 2024. And they see the Fed cutting rates at a slower pace of 25 pips each quarter. They see the Fed funds rate at 4.25% by the end of 2024. Bank forecasts with their wet fingers in the air once again. Right, let's have a look at the pricing, really, see what's been going on. So cable's looking a bit bullish at the moment, just breaking 121 as we're sitting here right now. So looking very positive. Euro still keeping a bit as well. And I think we're seeing euro sterling breaking down a bit at the moment. We're probably going to differ in opinion between me and Kate. I don't think this is anything to do with the Brexit stuff. I think this is purely the greater volatility that we get in cable versus euro dollar that we see sometimes. For example, if euro dollar moves 30 pips, cable's likely to move 50, 60 pips, something like that. I think this is just a volatility move rather than a move on because the pound or the UK is suddenly the best place to park your money. But the price action is the price action. At the moment, it's looking like it might be breaking down a bit. If we're under 87.60s, keep an eye on this low here, around about that 60 area, then we could begin to push down to the next level, 87, 87.20-ish down there, that prior low that we saw. And that has been a previous support and resistance area historically. So watching this break here, I'm still long. I missed a long off there last time. I would be looking at it again to add to my core position and to play some in the short term for that one. Now, Kay will show you this probably in the crosses. They have all been ratcheting higher, again, pretty much based on the yield situation that's been going on. You know, you can pretty much pick a cross and they're all looking the same at the moment today. So heavy euro buying coming in oh, get rid of that again. Oh, how do I get rid of it? Let's go on to that. There we go. So buying coming in the crosses. Euro dollar is moving as well, as we can see, but it's not rocketing higher. So I still don't know what to make of this one. What do you think of this one? Still euro dollar. It's can't quite get 105. It's not really bouncy. You know, what's it doing?
I'm not convinced either way. I mean, really, for me to get bullish, we need to break above the. Let me look. I was looking at the 1 hour chart actually. For me, that's really strange. But I think there is a minor resistance around 106.25, 26. But really, I think we're just chopping because we have both central banks. I mean, the big picture is we have both central banks having to be more hawkish than expected before. So, you know, they're kind of pulling from both sides. So I think we're ranging in the euro. I mean, of course, we could go 100 pips either way, but nothing. You know, if you're looking at day trading, that's a different story. But for me, in terms of the kind of the more lengthy view and a more medium-term view, at the moment, I think we're going to be ranging, and it's going to continue until we get inflation moving more one way than the, you know, in the US, let's say, than the eurozone. I think that personally, I think that's the most probable scenario, that the inflation in the US starts dropping before that move happens in the eurozone. And that's why I think the most likely move is we move up towards testing the 110 highs. But obviously, this is not going to be today or tomorrow or next week. But so to answer your question, I think we're going to be ranging for now until we see some economic data that make the difference. And as I said before, I think that it's going to be USCPI that starts it.
I'm going to scare Kay now, mate. Is that an inverted head and shoulders we got forming there?
Huh?
Looks like it.
Don't make me draw it. I refuse to draw it. I'll let you pick that one out. You like the shampoos more than I do. But yeah, so the euro crosses are really helping keep a bid under the euro, but it's not rocketing as much as the others. And that cross is doing some damage, or not damage, but is keeping some of the majors under the cosh. So euro dollar, euro Aussie rising is keeping Aussie dollar contained here. Bounce is still looking very weak off this 67 handle, but it is holding. So we've got a little bit of a range developing. 67.50, 67.00. Could be that the market moves more significantly depending on which way it breaks. If it breaks up, still got a lot of work to do to get back up towards that 68 handle. So for now, the bearish pressure remains in place, and on balance, maybe the chances are that it breaks lower, more so than it breaks higher. Same situation for Kiwi. We had the break under 61.90, 62s, finding support into 61.30s. Bounces again pretty weak. It's almost a mirror image of Aussie dollar. So this one I'm still short in, and just waiting to see what happens. I'm looking for a break under these lows to get us maybe down to 61, and then start pulling my stops down from just above here, this area 62.25. I want to get my stops down. I've already taken some profit down here, but I want to start locking in the rest of it. Dollar one has looked like it's had enough having a crack at 7 level for now. We've had a bit of a pullback. Again, a bit of a yield follow on this one. We had a move up and yields, you know, in the US bounced, and then they've come off a bit, and this has been pretty quick to come off. The fix yesterday was still around the 6.95s, so keeping things a bit steady. There's a bit of support here, 6.95, 50, 60. It's had a little look under down to 6.94s, but it got back above pretty quickly. So a bit of an area developing. They got some small steps going on here, 693.5. The big number is down 690, 691. If we get down there and hold it, that'll keep this rally in play. Then maybe we get another move up towards the 7 area. But if we're back under here, things are going to look a lot less rosy. I've got my stops now just below there, 689.50, just below this area here. Trading stops up. So if we do break under there, might be looking a bit uglier for this pair at the moment. Kay, do you want to take a flying visit around the pairs?
Yeah, sorry, I had my microphone off. Just to come back on what we were saying on the let me grab the cable. On what we were saying on sterling. You know, I think because we just printed the high on the cable here. If you look at the really short term, look at what time we printed the high on the cable, bang on the hour. So I think there's a bit of end of month fixing going on there as well in sterling, and it's clearly on the buy side of sterling, and it started early in the morning. But no, yesterday I was saying like, okay, if we get back down into this zone, I'm gonna have a stab at it. But from there it just went 150 points higher, and so I missed the whole thing. It happens. But as I used to say, as I'm pleased to say, it's better to miss one than take it up the lederhosen, right?
That's a nice one.
I'll let you explain that one.
Sorry?
I'll let you explain away that one.
Oh, yeah. I mean, it dates back to when was it? 1980s. When I started working, we were when I started working in Belgium for Citibank, and our main broker was Bierbank Düsseldorf. In those days, they were like #1 dollar mark broker on the planet. And our broker, he sometimes came up with that thing, and I just found it so funny that I just took it and use it as my own right now. And that dates back 40 years or nearly 40 years. So and the lederhosen is those leather pants that the Germans wear when they do the. You see a lot of them at the Oktoberfest in Munich and things, and then they slap each other like it's kind of a dance or tradition. They slap each other on the lederhosen, and sometimes it hurts a bit. So that's why the expression is also can be used for the markets as well. If you take it up the lederhosen, it hurts. So yeah, I think there's this zone again that we have to look at in the cable, and again, we are looking at we are in the end of month territory, right? So what I'll be looking at is where we end up after 4 p.m. And where we start the month next month. But as Ryan already shown those yields in sterling. If yields keep up in the sterling, it's going to put a natural bid, I think, under the sterling, unless we get bad economic data again come March. But it could. I'm much more neutral than I was in the past. In the past, I was really the past months or so. I was like a rally seller on sterling, and sterling was going to go down. But I mean, people in the room know. Since the end of last week, and I've pretty much revised my opinion, and I'm more neutral, but I find sterling finding better bids easier than it was in the past months, and it translates as well on the euro sterling, right? We're trying to get back below this support here. I had a bit of support in this 87.75 down to 87.60s, as Ryan was already showing. We are not yet at the real danger zone. This is my danger zone here, just below 87. But depending on whether sterling strength continues after the end of month, I wouldn't rule it out to go and have a look back in those lows, right? I wouldn't rule it out at all. And I could see sterling behaving relatively well for the time being. So that's a bit my my view on the sterling right now. Yeah, we have seen this breakout on all the yen crosses, and it's been pretty violent on the sterling yen as well, just with 4 big figures higher than on Friday. I think we are entering a bit of a resistance zone anywhere between 165.75, not too far away, and around 166.60. So keep an eye on that zone, and I'd say especially starting of March, whatever may happen now can be attributed to end of month. The yen is behaving relatively weak. But of course, in the yen, we have to take into account what's happening here on the dollar yen. We have this confluence of MAs on the daily. We've already shown that the cloud dropped away, right? That is going to provide us with a bigger zone now, 134. Call it 134.80, 135.20 is going to be a big support zone now if we ever make it back down there. On the top side, I don't know what's to happen on month end or so, but we are coming into big zones here, anywhere between this 137 and even pull it up to 138 really, and this. We are trying to hold the break here of this trend line, and yeah, I'm not 100% sure what to do with dollar yen here and now, but I'm a bit long euro yen, and it showed on the longer end as well, and the 138 here is going to be another big zone for the dollar yen. There's a lot happening in the next 100 to 150 points, right? We have this 136.67 here as well. There's a lot happening, so we have to be very careful what we do with the yen going into March, especially I think ahead of the last Kuroda's Bank of Japan meeting on the 10th. Sorry, oh Jesus, so it's really a big zone that we have to monitor here. And then, as we've spoken about it, looking at a little bit further, we have to know what Ueda is planning to do if they really don't use this window to do something about monetary policy. And I don't know where we are going to stop really, and I'm starting to be in doubt that they're really going to do hard things. I mean, if they do, then as I said, we can get back to this zone here, 127 down to 125. It's possible if they change if they start to change monetary policy a bit more aggressively. But if not, I don't even want to dare to put a rate on where we could go right now, and I'm really not excluding the possibility that the market at one moment is going to turn around and say like, well, you guys missed it and take the yen much weaker. But that's music for later, of course. In the shorter term, those are the levels. Euro yen, right? We had it this from the highs. We are now in a serious attempt of breaking it. It's around 144.5, and we're trading above 145. So I think, I don't know whether it's end of month. It is possibly end of month. I'm going to be very careful with what's going on into the 4 p.m. this afternoon, and I'm for sure going to take some off if we if we reach 146s. But again, this one, it's a break, and even on the shorter term, we had this wedge as well going up, and that broke around 142, 2030. So we have a double layer of short term. We have a double layer of very short term support already around here. So I think if by the end of the day we're back below here, it's I mean, it's a free trade anyway for me right now. But I'm probably going to take it off, because that means that dollar yen will have found the top as well, or euro dollar coming off, starting to come off as well. But yeah, these yen pairs are in break territory. So now we have to monitor what's going to happen after the end of the month, because month end can always have some surprises in it, and then on the first or the second of the next month we reverse the whole thing. Silver, I finally, that was my plan. I finally started to reload, but in extremely small amounts. Yesterday around 2070. I'm still not convinced that it's the bottom, so I'm keeping it very, very small. To tell me that it's going to be a bottom in silver, okay, this 21, 10, 15 probably, but the big one for me, of course, the big one is 24.5. But to tell me that it's really going to shoot, we have to break back above 22, basically. Above 22 bucks, I'm going to pay up, because I think then that means that the whole thing is done. In the meantime, I'm going to be very, very shyly start to add to my long term again, down to 1870s for sure. And I will not, even if it comes down here, I will not be in a full position. I will still monitor the bounce and still keep some out of risk management considerations for one, and for two, if it comes down here, that means that the dollar will still be very, very strong, and we have to be still very careful. But I am slowly re-entering. Gold, I have no clue, to be honest. We are on prior levels here in the low 18s. I think unless the dollar flips around completely, there's still a possibility that we are going to see under 18 down to 1780s. But I have no clue on gold. It needs to retake 1830s, in my opinion, to take away the bearish pressure for now. So yeah, that's a pretty decent zone here, 30.32 on gold. If that starts to break up again, I think we may be talking about something different. Anything else? Oh yeah, let's have a quick look. People were asking about the Aussie. Aussie, to me, a bit of a zone here around 67.20, and then the next one comes in 66.85, 66.70, 66.70.85 is the next relatively important zone on the Aussie dollar. And as Ryan was already saying, we need to retake 68 for a starter, and then I think here that could be one which is in play. And if you 71.5, 68 now, it's three big figures. This could take us all the way down to the 61.8 if this head and shoulder plays out. So that could be a big target here. So keep that one in mind if Aussie continues to show weakness. That's still 200 points or 150 points away. So, but hey, keep it in mind. We never know. Could be a possible target. Kiwi, Ryan already spoke about it. Aussie Kiwi is stabilizing in the low 109s, still 108.75, 85, I think. And then on the top side, 109.60. If we retake 109.60, 109.80, then this may be over. But for the time being, I don't see too much reason for Aussie Kiwi to go to trade materially higher, because as we already said, the differentials between the RBNZ and the RBA are likely big enough to keep some sort of a lid on this Aussie Kiwi. Euro Kiwi, I tried, but it's very small. I tried the break last night. See where this leads us. Coming the 4 p.m. It's really an end of month trade based on the monthly moves in equities and stuff. And I've already took some off this morning around 70. So if it goes back down below 171.5, I'll be out of there. And it's going to be a really, really small risk trade, this one. And Euro Aussie, well, it's no, I need to go back onto the 4 hours. It's broken the triangle pretty violently. We are already trading 250 points higher, but on the longer term, we are entering or nearing some kind of resistance. You've got the 158.10 that we tagged this morning, and then here we have a bit of a trend line coming in. This is a prior high, prior low, and that is around 159. Around 159 and a quarter. That's going to be for the more medium term, the zone where Euro Aussie has to cap, or it may mean really bad news for the Aussie, or really good news for the euro in turn. So this is one that I'm keeping an eye on, and that's basically it. Ryan already showed dollar China. I don't know whether it's end of month going on there, but I could imagine that we are seeing support coming in 693, 694 on the dollar China once month end is done. Yeah, and the battle for 7 may still only begin. I think people towards the end of the month have taken the advantage of being close to 7 to take profits, and for the time being range, I'd say. And here's another one. People don't know that I like this one. I'm flat for the moment, and I was really hoping for a return into this at least 119.67.75, but I'm not even getting as much. I really would love it to correct a little bit before we start to go lower again. If we break prior lows, it's really meaning bad news coming into or good news for the mix going into March. Same thing for the dollar mix. It's just hanging around its lows, and it can't regain the 1850s. So price action is not supportive for this pair at all for the time being. And I'll leave it there. Back to you, Ryan.
Thank you very much. Stel, you want to have a look at anything tomorrow? Or,
yeah, I'll do that tomorrow. Yeah, we've gone up almost past the hour now. So yeah, tomorrow I'm going to have a look at stuff.
Yeah, fantastic. All we've got on the calendar for the rest of the day is some house price data from the US, but US consumer confidence is probably the number you want to keep an eye on today, and those all important inflation expectations to play into the Fed trade. So we shall leave that there for now. Thank you, as always, to my 2 colleagues, Kate and Stel. Thank you, guys.
Thank you.
And thank you to all the viewers as usual for coming. Yep, cheers, mate. Thank you very much. Hope you continue to recover. We like you fighting fit. Yeah, thank you to all the viewers for coming to the Flow Show. Hope you're enjoying it. If not, let us know. And we shall see you all tomorrow. Thanks for coming.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.